Hello and welcome to another visual presentation brought to you by Dean Myerow and kickerbond.com. In today's presentation, we will cover the basics of kicker bonds, and we will show you how kicker bonds can be an impressive option in a municipal bond portfolio strategy. For investors concerned with rising interest rates in the muni bond market, kicker bonds can be one of the more defensive ways to invest in municipal bonds. So what makes a kicker bond? Kickers are bonds that have a higher coupon rate than is generally available on currently new issued bonds of similar quality. All kickers have one thing in common. They all can be potentially called in a short period of time. How do kicker bonds work? Kicker bonds, as suggested by their name, offer an investment feature that some professional municipal portfolio managers find extremely attractive. The yield on the bond investment rises at each milestone call date that passes without the bonds being called or retired. Thus, an investor in kicker bonds should want his or her bond investment to stay outstanding for as long as possible to earn the enhanced, kicked-up yield. The key to successful investing in kickers is earning a positive yield to the first call that the investor is comfortable with. A good kicker portfolio still produces a better than money market rate on the kicker bonds that are called. An investor recognizes that many above market coupon bearing bonds will be called prior to maturity and hopes to have enough bonds in the actively managed portfolio that are not called and provide a kicked-up yield. Kicker bonds typically have a very short duration because most are callable in a short period of time. This, in theory, makes kicker bonds less sensitive to rising global interest rates. Here we have an example of the ideal behavior of a kicker bond. The bond we chose to showcase here is for the Port Authority of New York and New Jersey. An added benefit of this bond is its tax-free status for not only New York but New Jersey residents as well. This high-quality bond has a coupon rate of 5%, which remains for the duration of the bond's life. That never changes. Take notice of the date of first call for this bond. The investor in this scenario might earn 1.25% federally tax-free and possibly state tax-free until July 2018. If the Port Authority does not call this bond on the first call date, then you'll see the yield may kick up significantly from 1.25% to 3.65%. This is because the bond has had another full year of accumulating that 5% coupon rate. This may continue up until the bond is called. The worst case scenario is the 1.25% is called on the first call date. This bond, if it were to reach maturity in July 2021, can see a yield of 4.38%, which would illustrate the best possible case in this scenario. So, what are the pros and cons of kicker bond investing? Kicker bonds have shorter durations and are not as sensitive to price changes if interest rates rise, which is also why they've been termed cushion bonds, since they absorb interest rates better than most other bond structures. Also, kicker bonds can give potentially higher portfolio yields. The cons of kicker bond investing include less potential price appreciation, meaning generally kicker bonds do not appreciate in value when interest rates fall due to the fact that their call feature at or near par is potentially around the corner, as well as the potential for high portfolio turnover. Kicker bonds can be called more frequently than non-callable and long call dated bonds, and need to be replaced, which might produce higher transaction costs for the investor than investing in non-callable bonds. This concludes our presentation of kicker bonds. For more information, please visit kickerbond.com. Thanks for watching.